Here's what a strategic conversion approach looks like. First, you map out your tax brackets for every year between now and when your RMDs begin. You project your income sources, and then you identify which years you have room in the lower brackets and how much room exists. Second, you wait until Q4 to finalize your conversion amounts. By September or October, you know your actual income for the year. You can calculate precisely how much room remains in your tax bracket, and then you can execute a conversion in October or November, leaving buffer time between the December 31st deadline. Third, you model all costs, not just federal tax. You calculate the state income tax impact. You check whether the conversion will push you into an IRMAA bracket 2 years from now. You model the Social Security taxation effect. You run the numbers for both spouses and consider what happens to the surviving spouse tax situation. Sometimes this analysis reveals that the optimal conversion amount for a given year is zero. Fourth, you plan for the survivor scenario. When one spouse dies, the surviving spouse moves from married filed jointly to single. The tax brackets for a single filer are roughly half the width of a married bracket. RMDs continue at the same dollar amount, but now they're taxed at higher rates. So strategic conversions during your joint lifetime can dramatically reduce the tax burden on a surviving spouse. The question isn't whether you should do Roth conversions. The question is how much you should convert, in what years, while accounting for all the secondary and downstream effects. You get that answer wrong, you've paid taxes you don't need to pay. You get it right, you've potentially saved 6 figures over your retirement while creating more tax flexibility for both you and your surviving spouse.